Now, let me take this opportunity to welcome you to our today's session, whereby we are looking on advanced financial management syllabus, and I just want us to continue from where we left. And remember, the last time I was with you, we were dealing with advanced payback periods, not at the advanced, but we were looking on the discounting techniques. And you can see that these discounting techniques, because we said when we are doing the capital budgeting, it is normally categorized into two. It is normally have discounting, which basically is normally called modern, and discounting, which is basically known as the traditional techniques. And the grouping of them was done in our first video, which is our introduction part. And I also need to be able to say that before we do the discounted payback period, I remember the last time I was able to tell you that it is just similar to payback periods. And if I want to define a payback period, I say it is normally a duration which is basically taken by the project to generate sufficient cash flow required to recover the initial outlay. And I normally say that if we are running certain businesses, you can see how we basically have to be dealing with the issues of break-even. Majority of us basically normally have a concept whereby we have to be analyzing the cash flows within the organization, giving out the reports, which we can be able to this information, which can be able to assist the decision makers for making sure that the organization is moving to the right direction, because a new organization, and then it can be able to break even. So what do we normally talk about the break even? And I remember we said our break even, in this case, under the advanced financial management, we said is our IRR. And we remember the internal rate of return, we said it is where the present value of the cash inflow is basically equal to the present value of the cash outflow. When we go to the management aspect, we management accounting aspect, we normally say that the break-even is where the total revenue equates to the total costs. So it means the profits of ours should be equal to zero. So in our advanced financial management, our profit, our NPV should be equal to zero. And that point normally arises when we are analyzing our IRR. We said it is our break-even for the discounting technique. So when the NPV is equal to zero, then that is when we analyze our IRR. Those are the things that we have already discussed there before. We remember also we were able to analyze the issue of accounting rate of return, and we said it normally uses the accounting concept in making decisions. And basically all those analyses we have encountered there before are going to be assisting us to understand well about advanced financial management. Now, when you look on the aspect of discounted payback period, I'm saying it is just similar to the payback period, and in all aspects, expect that we use the discounted cash flows. So when we're analyzing the discounted payback period, we can just be able to say it is similar. It is basically similar to PBP, except that the payback period, except that it normally uses discounted cash flows. It basically uses discounted cash flows. It normally uses discounted cash flows. And in this case, when we are discussing about the discounted cash flows, we are saying they are normally called present values. Present values. So it means I have to be looking the number of years, take your cash flows, you discount it using the cost of capital and get the present value. And we remember we talked about the usage of the discounting. And I said this topic, you already done it under the time value for money, where we talked about time value for money being the determination of the present values, right? The determination of the present and the future values. So the future values can always be determined when you are using compounding, but the present values can be determined when you use discounting. So you remember, if already you know about the discounting, it means you have already given a futuristic amount, which you need to be determining how much can I be able to invest today. But if we are discussing about the determination of the future value, then it means you have to be looking on the present values and then you determine the future, right? You can be able to determine the future values. So those are the things that I just want us to look at. So if already you are in class last time, you can be able to look on the question of November 2017. Let me look on the question of November 2017. We have already done it in our first video, question 1B, right? Question 1B. And because already I know very well that we have already watched our first video. We remember that we say that when we want to calculate the NPV, the first thing is to determine the initial outlay. And when we were able to do our initial outlay, we were able to get it how much? The initial outlay of that question, we were able to get around 20. The initial outlay was how much? I remember we were able to get around Kenya shillings 62,000, right? Someone might be asking, Mwalimu, where is the 62,000 coming from? And remember, this is what we have already done in our first video. So that is why I say, always watch the videos after the classes, right? Then the step number 2, we say, always calculate your annual net cash flows. Annual net cash flows. And when we look on that question, the annual net cash flows, we were able to get 22,000. Those are the annual net cash flows. Those are my annual net cash flows. The annual net cash flows is 22,000. Then number 3, we say determine the terminal cash flows. Terminal cash flows. And you ask yourself, how much was our terminal cash flows? I will be able to tell you, we were able to get 17,000. NPV tutafanya sana, hata isikupe wasiwasi. Utaifanya mpaka tukamaliza hii topic. NPV. It has to be calculated in all aspects. So in this case, you can be able to say, if for instance, I want to determine the payback period, right? We said, we normally deal with 2 types of cash flows. We normally deal with irregular cash flows. And we said we can deal with regular cash flows. Someone has unmuted, please. So the irregular cash flows is when you find each year, the figures or the cash flows are not similar. For example, here, you find in year 1, for instance, the cash flow is 10,000. You look on year 2, the cash flow are 3,000. Year 3, right, we get about 4,000. When you look at it, the cash flows are not similar. That is what you normally discuss about irregular cash flows. But what about the regular cash flows? The regular cash flows, I can just write like this. 1 to 7 years, our cash flow can be Kenya shilling 50,000. Then you can see these are regular cash flows. Each year I'm going to be receiving 50,000. Irregular cash flows, you can see they are like lump sum. In when you look on section 3, this is what we were calling lump sum. And when you look on this, we used to call it annuity. I just want to give you a good basics, and so that you can be able to understand. So if I can be able to use this illustration in the 2 scenarios, for example, I can do it with regular cash flows, because you can see we have the annual net cash flows of 22,000, right? 22,000. And then we have our initial outlay of 62. And we say the PPP, it is the duration taken to recover the initial outlay. So how do we normally get our PPP? Right? You normally take the initial outlay, right? We divide by our annual net cash flows. I just do a recap, annual net cash flows. So the initial outlay of ours is how much? So you can see our initial outlay is 62,000. What about the annual net cash flows? The annual net cash flows of ours is 22,000. You just do it direct. When you find the cash flows are similar for the duration of the project, right? When you look on the cash flows, you find they are the same for the duration of project. So how much is this? So when I divide here, I'm going to be getting 2.81 or 2.82 years. We only need 2.82 years to recover the initial outlay. But what if we use the irregular cash flow, right? If we can be able to use the irregular cash flows, how can I be able to determine our payback period, right? I can say, right, when you are making a decision, because sometime an examiner can give you a certain question where they are going to be analyzing the PPP, right, under the irregular. And then I can be able to give you an NB, and I say the lower the BPP, NB here, the lower the payback period, the lower the payback period, right, the better the project. The better the project. So every time unapata, mimi nikiinvest, niekelee pesa yangu kwa kabiashara, 500,000. Within a period of 4 months, manze ishanirudishia, then I will be able to, or I will be very happy because the business is able to give me back my capital. So that is what we are discussing here. The longer the payback period, the better the project. The better the project. Alternatively, you can be able to calculate your payback period in this manner, right? Take the number of years. The project of ours, the project that we were doing under the November 2017, only contained 3 years. Let us look on our cash flows. The cash flow generated here. When you look on our cash flows, you remember very well, right? How much are we getting each year? Then, after you get your cash flows, you accumulate your cash flows. Why are we accumulating? So that we can be able to generate 62,000. So the cash flow for the first year, tumepewa 22,000. Ama umepata 22,000. So pia hapo unaeka 22,000, right? Then you go to the second year. The second year, you also put 22,000 because we are generating from year 1 to year 3, we are getting 22,000 each year. So here we are getting 44,000. But now, if I had 22,000 here, I will get 66,000. Na mimi nataka only 62. So nakuja na place 62,000 of mine here. Najiuliza, how much cash flow do I require to generate 62,000? I just say, let me take 62,000 minus 44,000. You are getting 18,000. So najiuliza, payback period yangu ni ngapi? Nakuja hapa na kuambia, payback period yako should be, right, 2 years complete, right, and part of year 3. So hapo nakuja unaniambia 2 years plus 2 years plus how much cash flow do I require to get 62? Unakuja unapata 18,000. And to determine the number of months, you divide by the annual cash flow for that year. And in this case, it should be 22,000. Right? So it will be 18,000 divided by 22,000. Getting 0. This one it is 0.82. So at the end of the day, you are getting 2.82 years. 2.82 years. 2.82 years. That is how we normally get it. Ungetumia hii ama utumie, you are getting the same, right? But what about our topic of the day, the discounted payback period, right? The discounted payback period. How am I going to be working with it? And in this case, I say, because we have said, always we normally use the discounted cash flows. So I just take the number of years of mine, right? We have year 1, we have year 2, we have year 3. And then we take our cash flows. Right? Hapo nakuja unaniambia, mwalimu year 1 we generated 22,000. Year 2 we generated 22,000. But year 3 we have to factor terminal cash flows. Terminal cash flow plus the annual net cash flow. Annual net cash flow. Because already we look on year 3 lazima nipate terminal cash flow after the completion of the project. Na bado kuna cash flow which was generated in that year. So our terminal cash flow is 17,000 plus the annual net cash flow of ours is 22,000. This equates to that 9,000. That equates to that 9,000. So that is what you place here. That 9,000. Let us look on our discount factors. At what rate? the discount factors. And in this case, you find very well, the discount factor, when you look on that question, our discount factor is at the rate of 10%. So once you look on the discount factor at the rate of 10%, we get our present value. Our present value. So ask yourself, right? Ask yourself, what is our discount factor? So we say, in this scenario, mwalimu, the only way we can be able to get our discount factors is by use of lump sum, right? You can see kila mwaka lazima generate yake. So kama ingekuwa year 1 to year 3, so in this case tunatumia lump sum. So the formula for lump sum, I remember the last time Joy or someone else was able to tell us, if we are dealing with lump sum, the formula will be to determine the present value interest factor annuity, or the present value interest factor, sorry, the present value interest factor. Tunaipatanga tukichukua 1 plus r, we raise for negative n. We raise for negative n. In this scenario, let us get this. Let us get this. So how am I going to be getting it? So in this case, I say, for the first year, it will be 1.1. I raise for negative 1. Right? Very simple. 1.1, I raise for negative 1. Someone may be asking, why is it 1.1? Because hapa nimechukua 0.1, which is our rate, plus 1, getting 1.1, right? So when you place on your calculator, you're going to be getting 0.9091. 0.9091. What about for the second year? Mina edit to kwa calculator angu, and I will be able to get 0.8264. 8264. And then we have year 3, where we have 0.7513. 0.7513. In this case, I can say, to get the present value, take your cash flows, add with your, you multiply with the discount factors. So for the last one, it will be that 9,000 times 0.7513. Getting 29,300.7, right? 29,300.7. What about the second year? It will be 22,000 times 0.8264, right? Getting 18,180.8. Then the first one will be 22,000 times 0.9091. We are getting 20,000.2. 20,000.2. Usiniambie mwalimu to add. No, we are not adding. So in this case, nakuja hapa najiuliza, how can I be able now to get the discounted payback period? Nakwambia hapo sasa ndio kazi inaanza. Because we say, let us look on the present values. Let us look on the present values, which we have there, to determine the discounted payback period. So nasema now, your time to do the discounted payback period. So here I talk about the years. Then hapa nitaongelelea the present values of mine. So tuko na year 1, tuko na year 2, tuko na year 3. And then we accumulate our present values. At the end of the day, we need to get our initial outlay of how much? Our initial outlay of 62,000. So the first year will be 20,000. Here we talk about 20,000.2. Once you accumulate it, it will be 20,000.2, right? After that, now we can go to year 2. The present value is 18,180.8. Once you accumulate, just take 20,000, right? 20,000.1.2, sorry, plus 18,180.8, getting 38,181. Sindio? Kama nita add 29,000 to my bracket, right? 0.7, nitapata more. Nitapata 67,000. Kama nitachukua ile present value yangu ni add yote, nitapata more. So what should I do? Wacha niweke 62,000 here, ni only determine the present value which I require. So nasema tu, let me take 62,000, which is my initial play, minus 38,181. Niseme, nahitaji tu 23,819 and not 29,000. So to determine the discounted payback period, unakuja hapo unasema, right, it is very good. I have already used 2 years fully. So unasema ni 2 years plus 2 years plus, now I take the present value required for year 3, which is 23,819. Then we divide by the total present value for year 3, which is 29,300.7. So how much is this? How much is this? Mimi nakuja tu hapa nasema divide by 29,300.7, getting 0.81. So I just require 2.81 years. 2.81 years. 2.81 years. That is why we said they are similar to PBP. The only challenge that we have is because this one uses the present values. It normally uses the present values. Any question? Any question? Any question to that point? Lillian, is it okay? Is it okay to that point, Lillian? Let us talk. Let us not keep quiet. Let us okay. Talk. Rose. Hello.
Hello, it's okay.
Here.
It's okay.
Joy is asking, why did not you use 62,000 in discounted payback period? Na si nimetumia ndio hii. Nimetumia, it is here. That is why I've used the initial outlay to determine the number of the present value required. Remember, for year 3, the present value required there is 29,300.7. But how much do I require to get only 62,000? Now I require 23,819 to get 62,000. I don't require the present value for the whole year. No, I require part of it. Part of it. Part of it. Immaculate, is it okay?
Yes, it's fine.
Thank you. Now, I just want to do the last thing under the these techniques, investment appraisal techniques, right? And I will be able to tackle the modified internal rate of return. Because I just want us to get started to serious things. Modified internal rate of return. Modified internal rate of return. And we can say it is just similar to IRR, except that instead of discounting the cash flows, we compound the cash flows, right? We are saying it is similar to internal rate of return, except that, right, instead of discounting the cash flows, we normally compound the cash flows. We normally compound the cash flows. We normally compound the cash flows. So how do you normally get the IRR? MIRR. And I say, to get the modified internal rate of return, we normally take, right? We normally place our number of years here outside the loops. Then we look on the total future values. The total future values, you divide by the initial outlay. So after you calculate these, you subtract 1. After you calculate that, you subtract 1, right? Then after that, I just want us also to use the same scenario. the same question, right? Where I'm saying, let us use, right? Is it 2017 November? November 2017 illustration. And in this case, when you look at it, we had only 3 years. So we have the number of years, and then we have our cash flows. We have the number of years, we have our cash flows. And in this case, remember, the determination of the future value is normally done by the compounding, right? So our discount factor here, we have our discount factor at the rate of 10%. Then we are going to be determining the future value. So we have year 1, we have year 2, we have year 3. We have year 3. And in this case, we are looking on the cash flow generated for each year. Year 1 was 22,000. Year 2 was 22,000. Now year 3 we said was that 9,000 in total. So how am I going to be calculating the future value interest factor? The future value interest factor, R% n years. It is normally done by taking 1 plus R, you raised to power n. In this case, there is no negative. When you look at it, there is no any negative. It is 1 plus R, you raised to power n. So how am I going to be doing this? I say it is very simple. Since we are looking on, if today you are investing 22,000 at the end of the year, how many number of years for investment? You say it will only stay in 2 years because it is invested in the end of the year, unless otherwise stated by the examiner that it was invested at the beginning of the year. We assume that it was invested by the end of the year. So in this case, unaniambia mwalimu, hii pesa inakaa kwa account for only 2 years. So nakuja hapa nakwambia, you take 1 plus 0.1, but you raise to power 2. You raise to power 2 because hii pesa, if it is an investment, it is going to be staying in the account for 2 years, for only 2 years. Remember, these are the present values. We want to determine the future value. What about this one? Unaniambia mwalimu, before the maturity period, it will only take 1 year. So unaniambia 0.1, we raise to power 1. Then the last one will be 1 plus 0.1, then we raise power 0. Because already, after the 3rd year, hii pesa yote ina mature. That is why tunasema mwaka ya mwisho, we raise power 0. We raise power 0. So in this case, I know very well, this is 1. This is already 1.1. But how much is it?
Excuse me.
Yes, yes.
Excuse me.
Yes.
Could you kindly explain again on the discounting factors, the whole power 2, power 1 kindly?
Okay, I've said the cash flow that we are having, right? The cash flow that we are having here, we are assuming that they were received at the end of each year. Kama ni year 1, this was received at the end of the year. Ama if, for example, let me look on when you are being paid. When you are being paid. Unalipangwa lini? Now, when do you normally put money on your circles? Majority of the people are normally paid on 24, 25, 26, there, 27 to 30. So in this case, we are asking ourselves, when do you normally deposit those money to your circles? Unasema at the end of the month. Also, when we come to the cash flow generation, we are saying these cash flows are assumed to be received at the end of each year. Kila mwaka hii tuna receive at the end of the year. These are the end of the year. These are the end of the year, right? That is the aspect of the future value interest factor, unless otherwise stated that they were deposited at the beginning of the year. Always treat the cash flows to be deposited or to have been received at the end of the accounting period. So each year assume, you normally carry out an assumption unless otherwise stated. Unless otherwise stated, then we assume our cash flows were received at the end of the year. At the end of the year. So that is why I've said, if it is 22,000, I have deposited 22,000 in my account. It will only stay on my account for only 2 years because year 2 and 3, and then it matures. When you look for the 2nd year, it will stay for only 1 year, the 3rd one, and then it matures. But for the 3rd year, my project will now be, I will be able to terminate my project, and therefore they will not have any duration. That is why we are saying we raised power 0. Are we understanding? Is it clear now? Immaculate?
Yes, thank you. Yes, thank you.
Okay, thank you. I hope I'm not hanging. Is my voice clear? Is my voice clear?
Yes.
Thank you. Now, in this case, when I take the cash flows, I multiply by this factor. The first one will be 39,000. What about this one? So once you take 22,000, right? We multiply by 22,000, you multiply by 1.1. I'm getting 24,200. What about the first one? We just say 22,000 times 1.21, getting 26,620. 26,620. How much is this? What is the total now? What is the total? What is our total there? So it will be 26,620 plus 24,200 plus 39,000. How much are we getting? We are getting 89,000. 89,820. 89,820. Now, in this case, we have said to get MIRR, we take the total future values and then we divide by the initial date, right? So in this case, we look on the number of years. Our N year is 3 because our project takes only 3 years. So I just say 3 years, then we root by taking 89,820, we divide by 62,000. Once we complete doing all this, we subtract 1. We subtract 4. That is what we do. So let's start by doing the under the roots. We are getting 89,820 divided by 62,000. Right? Then it will be cube root, right? Cube root of 1.45. Then after we get this, we have said we subtract what? We subtract 1. So how do we normally do this cube root? I said, let me say to you, because I know it is not this class, it will be, you write your 3 on your calculator. You place 3. Right? We are having 3. You can see there is a problem with network. So it is 3. Then we shift. We do 3. Remember your calculator has something looking like this. There's something looking like that. So we normally shift and this button. Shift and that button, right? You first write 3 and shift and this button, you're going to be having something looking on like this on your screen of your calculator. We're going to be having something like this. So the 3 will be the whole number. The reason is why I'm not using the one on the far end. What if you had 5? What are you going to be doing? I know there is a cube root button on our calculator. We can get it straight away. But what about if you don't, you are having a different number here, like 6. Ungefanya nini? So that is what I just want to do. So I have said you just press 3 from your button, then you shift, and then we have this button, right? You press it, and then this is what is going to be appearing on your calculator. Then you put 1.45 equal sign. You're going to be getting, right? You're going to be getting 1 point, it will be something looking like this, 1.131. Then we subtract our 1 now, where we are getting 0.131 or 13.1%. 13.1%. That is what you're supposed to be doing, right? That is what you're supposed to be doing. But what if the examiner was asking you to calculate the MIRR and advise the management? What could you have said? In this case, we say, when the MIRR, is greater than the cost of capital, right? When the MIRR is greater than the cost of capital, we say the project is viable. the project is viable. The project is viable. The project is viable. Have we understood to that point? Tumeelewa mpaka hapo? Because our MIRR, we can see it is 13.1%. Our cost of capital is 10%. Every time I calculate my MIRR equal greater than the cost of capital, then the project is viable. The project is viable. Any question? There is someone who has not talked. Godfrey? Is everything okay? Godfrey?
I'm okay, sir.
Thank you so much. Now,
Yes.
let me look on investment decision and risk and uncertainty. Now we have started getting to serious things now. I think the introduction is now clear. Wacha tuangalie exam na yeye anaficha mtihani wapi. And why are we supposed to be failing these exams? Are we supposed to be saying no? Why? Because AFM is bracing them. AFM is bracing them. Now, let us look on that aspect. I'm talking about investment decision. Investment decision under risk. Under risk and uncertainty. Uncertain. And uncertainty, something looking like that. So the most important thing here, and which I just want us to look at, is about uncertainty aspect. Right? The most important thing is about understanding how can we make decisions under risk and uncertainties. Now, when I look on the aspect of investment that majority of us have done today, I can understand very well that we are investing with the banks with awful that they will not, with our going concern concept that they are going to be staying in business in the foreseeable future and making profits. If, for instance, I've invested with SACCOs, which already we don't even do analysis whether they have already secured or they are registered with the CBK, or whether the companies act as allow them to operate within our jurisdiction. We are looking on what are some of the risks. Why do you normally say I can invest on Stima SACCO and not Mwasibu SACCO? I can be able to look on another SACCO like Wakadiri. Those are the SACCOs which are still here. We can also look on other SACCOs like Mwalimu SACCO. Why am I going to be investing on those SACCOs and not putting my money under the mattress? And the most important thing is because we normally say the higher the risk, the higher the return. And that is where we are going to be taking our risk at the end of the day, right? The risk will be coming across with uncertainty. The risk will be going hand in hand with uncertainties. And when you look on it, sometimes I can be able to tell you when you are measuring the risk, right? We say risk is measured using standard deviation. Risk is normally measured using the standard deviation, right? And it normally refers to the viability, right? It normally refers to the viability of expected returns with the actual returns of the project, right? It refers to the viability. To the viability, right? I think it should be viability. It refers to the variability. Sorry, it should be variability. Variability of expected returns. Expected returns with the actual returns with the actual returns of the project, with the actual returns of the projects. And in this case, the project that we are looking at, because already we have to be analyzing this aspect with the uncertainty concepts, because already here we are looking on the risk involved, right? What are some of the risks involved and uncertainties? And also we say, because it is normally similar to uncertainty, except that the risk has some probabilities, right? I can also put it here, right? That uncertainty is similar, right? Is similar to, uncertainty is similar to risk, except that risk, right? Risk has some probabilities, normally has some probabilities assigned. These normally have some probabilities which are basically assigned to it. And when we look on the uncertainties, they don't have probabilities. I will be able to take you back to QA under the topic we used to call decision theory. Right? We used to say that the decision-making criteria are the decision-making environments. The decision-making environments, we used to have 4. One, we used to discuss, this is out of our syllabus, by the way. This is not, I just want you to understand the concept I'm teaching there. We used to have environment of certainty, where we used to say here, the decision makers knows what will happen in future, knows what will happen in future. And we used to say this environment does not exist in reality, exists in reality. Hakuna siku tunajua what is happening next week. Number 2, we used to have environment of risk. We used to have environment of risk. And we used to say here, right, the decision-making process is based on expected returns, right, on the expected values, and we used to talk about the decision-making process based on the expected values, and we used to talk about the expected opportunity losses. Thank you for that. Opportunity losses. So in this case, we have to be analyzing the environment of risk. We are saying, can we be able to have 3 projects and then we look on the expected values, or we can analyze with the project which is having the least expected losses? Because here we are looking, making the projects, right? Because already we know the risk is normally contain probabilities. There are certain probabilities which are normally assigned there. Already I know very well, if I'm dealing with a certain company, right? If I'm dealing with a certain company, which already we are projecting or to come up with sustainability decisions based on how the company should be generating the cash flows in the foreseeable future, we have to be assigning certain probabilities to our projections. Now, in this case, the same applies when you are doing decisions, financial decisions under the environment of risk. And that is where we are looking on the decisions or the chances that we have, right? Or possibilities that we have to be projecting them to probabilities. And then we calculate with the initial cash flows to undertake the best project in decision-making criteria. I know number 3, you know very well we used to talk about environment of uncertainty. And I will not be able to discuss the 4th one. The environment of uncertainty, we know very well, it touches about the issues of not involving the probabilities. But we used to say it normally has around 5 decision-making criteria, rules, sorry. We used to have max. I remember we had something like this, max mini. We had Laplace, right? We used to have something called ways, something like that. And then we used to have minimax. Minimax, decision-making, minimal regrettable. It is a while, so I just remember if they were looking like that. So in this case, when we are looking under the environment of risk, no probability is assigned. No probabilities assigned. And that is why our statement here is talking about it is saying uncertainty is basically similar to the risk, except that the risk has some probabilities assigned, right? That is why we are having the differences between the two. So this was just for you to understand. That one was for you to understand. Right? So when you're making your decisions now using the risk, right? When you're making your decisions using the risk, we normally say the higher the standard deviation, the higher the standard deviation, the higher the standard deviation or coefficient. It is the one, another one which is coefficient of variation. The higher the standard deviation or coefficient of variation, the higher the risk and vice versa. The higher the risk and vice versa. The higher the risk and vice versa. And in this case, we are saying to measure the magnitude of the variance, right? Because that is why we have to be looking on the variances. We know very well to get the standard deviation, we have to be rooting our variance. Then that is where I've introduced the coefficient of variation in it. So in this case, we are saying they are the coefficient of variation the same. So that is why I've just put in my sentence into one. They are the standard deviation, the coefficient of variation, the higher the risk. So the biggest question is, how do we normally calculate? Calculating standard deviation. So how do we normally calculate our standard deviation? Now, by the way, it is normally written like this. That is our standard deviation. It is normally written, this is the symbol which means the standard deviation. So I remember there before in quantitative analysis and some aspect under the advanced management accounting for those who did it before we changed the syllabus, we used to say to get our standard deviation, we used to take the root of the summation of x minus x bar squared. Then if the probabilities are existing, we include there. I remember we used to use this formula, whereby these are the actual data. These are mean, right? And we know these are the probabilities assigned to these activities. But now here, we are not dealing with this. This one is basically replaced by return. And this one is basically replaced by the expected return. Expected return. So we're asking ourselves, how am I going to be writing our return? So under the formula, this would be R and this would be ER, right? So to get our standard deviation under the advanced level now, you normally take the summation of our return minus expected return here. We raised to power 2 or square, then we multiply by the probabilities. We raised to power probabilities. And in this case, I can say when under the presence, in presence of probabilities. Under the presence of probabilities. But what about the absence? We normally say when we have the absence of probabilities, or probabilities, right? When there is an absence of probabilities, consider the sample size. Consider the sample sizes. How am I going to be considering the sample size? I say when the sample size right? When the sample size is greater than 30. When the sample size is greater than 30, what are we going to be using? When the sample size is greater than 30, what am I supposed to be using? I say very well that when it is greater than 30, we can be able to say, to get our standard deviation, we can use the root of the summation of return minus expected return squared times, sorry, not multiplying the probability there, but we divide by n. But when the sample size is less than 30, when the sample size is less than 30, how am I going to be getting my standard deviation? I say very simple. Just take the root of the summation of our return minus expected return squared. Then we divide by n minus 1, n minus 1, n minus 1, just like that, n minus 1. But what about the coefficient of variation? What about the coefficient of variation? Because we have also, it normally measures the variance aspect. So how do we normally get it? I say very simple. If you want to measure the coefficient of variation, I say, when you look at it there before, we used to say, take your standard deviation, you divide by mean, then you multiply by 100%. I remember that is what we used to do there before. But that is not the case under the advanced financial management. So this it is basically replaced by, when you are getting the coefficient of variation now, you take the standard deviation, you divide by the expected return, then you multiply by 100%. You multiply by 100%. You multiply by 100%. To avoid all these theories, because it makes a lot of things, right? And because I don't want to cause your class to be so boring with a lot of theories, let us go to May 2019. There is a question there, a big one, by the way, where we are going to be starting by calculating our NPV. Very good. So for those who did not understand the NPV, you still have the chance. You still have the chance. So in this case, it's very simple. In this case, we are discussing about May 2019, question number 5A. Na nimeanza kufanya maswali mingi sasa. Tumeanzia safari. So it is just upon you to do your revision thoroughly. So in this case, let someone be able to read for us. So let me go to the questions. Let me look where they are. So our questions are where somewhere here. So we are discussing about 2019. And by the way, we don't have another chance. We always have one chance, one chance. When I was doing CPA, I used to take it just like how we normally go to the interview. You are normally given only one chance and you fight for it, right? So let us go to May 2019. When you go to the interview, you normally fight, right? The same, I just want to have the same spirit. Let us fight to finish our CPA. It is good when I meet you on the streets. When I meet you on the streets, you are CPA K, you are advancing with your studies. So let us look on question number 5. Godfrey, can you be able to read for us? Godfrey?
Yes.
Go on.
Jessa Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputer at a cost of Kenya shillings 100,000 each. Installation cost for all the computers will amount to 8,000. It is estimated that once installed, the computers will increase the company's earning before depreciation and tax from 12 12 million to 12.5 million annually. The computers are expected to last for 10 years, after which they will be obsolete with no resale value. The operation manager proposes that the computers will be useful. Sorry, the operation manager proposes that computers will be useful for 15 years with no resale value. The marketing manager and the other urges that the company needs the computers for only 5 years, after which they can be disposed of at 50 shillings each. The probability of distribution of the useful life of the computers is given below. It is given as follows. You can see them as they are. The company is in the that percent tax bracket. The company's cost of capital is 20% and uses the straight line method of depreciation required. The expected net present value of the project. Number 2, the standard deviation of the expected net present value. Number 3, if the net present value NPV of the project is less than 200 Kenya shillings 200,000, the firm will be exposed to a financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution.
Thank you so much. You can see it is a question of what I was able to take you through. And you can see this question, you have to be analyzing it into 3 ways. There is a marketing manager who is saying that the computer need to last for only 5 years. There is operation manager who proposed that the computer will be used for 15 years. There is someone else who we are saying that the computers are expected to last for only 10 years, after which they will be obsolete with no resale value. So for both 10 and 15 years, we don't have a scrap value. But for only 5 years, we are being told each computer will have a scrap value of 50,000 each. Now, the first thing, or the first instance in which we want to be getting, because when I look on this scenario, the first requirement, the examiner is asking us to calculate the expected present value, So the biggest question is, how am I going to be getting the expected net present value, This is what you have to be doing here. This is what you do, right? Is what you do. All right, let me see. A minute. So we are saying when the examiner is asking you to calculate the expected, anything expected, right? Take the actual and then you multiply with the probabilities. What does Mwalimu mean? Okay. The examiner is asking us to calculate the expected, right? The net present value. So how am I going to be getting it? It's very simple. I just say, take the actual or the summation of NPV, then you multiply by the probabilities. So the first instance, or the first step in which we have to be following up, it is to calculate our NPV. We said, to calculate the NPV, the first thing, let us determine our initial outlay. Right? We ask ourselves, how can I be able to get our initial outlay? Just we have our Kenya shillings here. Right? We have our Kenya shillings. And then the first thing that we have to be looking on, it is the cost of computers. The cost of computers. And in the question, we are being told very well that one computer is going to be costing us 100,000. That is what the examiner was able to say. One computer is costing us, let me limit here to thousands. One computer is costing us 100, then we are purchasing 8 computers, right? So what are we getting here at the end of the day? We are getting 800,000. 800,000 there. Then we are being told by the same examiner that we add incidental cost. In this case, our incidental cost is installation. Installation cost. The installation cost for all the machines, we are being told it is 20,000. So you just add 20 there. Do we have anything else? We say no. So what should I do? I just do because we don't even have the we don't have sorry.
The installation cost is 80,000.
80,000. 80,000. Thank you. 80,000. Now we are being told very well by the same examiner that we don't have investment in working capital. So your initial planning gap here 880. 880. Now, when we go to step number 2, I have said you analyze it into 3 areas. Number 1, because we are looking on the annual net cash flows. Annual net cash flows. So we analyze for 1 to 5 years. Right? Kuna mwingine anasema 1 to 10 years. Kuna mwingine anasema 1 to 15 years. Right? And you know all of these are annuities. Now, in this case, examiner is telling us there. Let me read it. Let me read it here. Examiner is saying that the computers will increase the company's earning before depreciation and tax from 12 to, right? So what is the increase? Let me talk about it. Increase in earning before depreciation and tax is by taking 12,500 minus 12,000, and the increase will be how much? We say our increase is 500, right? Let us limit our thousands here. Our thousands here, right? They are limited. So in this case, here is 500. Here also is 500, and also here we are discussing about 500, right? Then we don't have a lot of pressure. Let us less our tax. Tumeambiwa this company is under 30% brackets. So our tax will be how much? All throughout will be 150. 150. 150. Right. Then we say the easiest way, by the way, to finish my annual net cash flows is to do what? To calculate, you add what? Depreciation tax sheet. So tulisema hii tunapata namna gani? The depreciation tax sheet. We said take your costs, subtract your scrap, right? Then divide by the number of years. Then this one, we multiply by 30%. The tax rate, inaweza kuwa hata 25%. So our depreciation tax rate, we start with the first one. We were being told each computer, if we look on the 1 to 5 years, each computer will have a scrap value of 50,000. So in this case, if we want to do 1 to 5 years, let me do it here. 1 to 5 years. So how am I supposed to be doing it? I say the costs, the total cost of the machine is 880, right? The 880 minus the scrap value of ours will be, we were being told is 50 per machine. Then we multiply by 8. Getting how much? We are getting 400. Then you divide by the number of years, which is 5 years, right? Then in all of these, we multiply by 30%. So how much is this? How much is this? So we say 50 times 8 is 400. 880 minus 400 divided by 5. Then we multiply by 0.3. How much are we getting for the first 5 years? We are getting 28.8. Then we go to 1 to 10. 1 to 10 years. So remember this is very simple because we were told there was no resale value. So it will be 880 minus 0 divided by 10 years. Then we multiply by 30%. So it will be 88. Then you multiply by 0.3, getting 26.4. Then what about the last one? It will also have no resale value, right? Divide by 15 years. Then we multiply by tax rate of 30%. So how much is this? Very simple. I say 880, right? 880 divided by 15. Then we multiply by 0.3, getting 17.6. And this is simple, how simple it is. Get your annual net cash flows. Bila kuteseka sana. Annual net cash flows. Annual net cash flows. So in this case, take 500 minus 150 plus 28.8. Here we are getting 378.8. Then here we are getting how much? 500, that is 350 by the way. 350 plus 26.4, getting 376.4, then 350 plus 17.4, getting 367.4. That is how simple it is. Then let us go to the third step. For this calculation, the third step will be what? The third step we said, calculate your terminal cash flows. The terminal cash flows we said, let us look on the scrap value for the new machines, right? The scrap value. No. Before we go there, we are analyzing 1 to 5 years. We have 1 to 10 years. Then we have 1 to 15 years. 1 to 15 years there. So let's start with the 1 to 5. We were being told 1 to 5, 1 to 5. We were being told the scrap value will be, we were given 50 times 8 machines, getting 400 here. But the other one too, we were being told they don't have a resale value. So the only duty that we have is to calculate our NPV now, right? We calculate our NPV. But what I know very well is that all of these are annuities. All of these are annuities. So what am I supposed to be doing? It is very simple. I'm going to be doing this. For instance, because already we have to be discounting. So I will do in this case. Let's talk about 1 to 5 years. To calculate the NPV, I say, take your cash flow. We take 378. 378.8 times the present value interest factor annuity, because it's annuity for 5 years, 1 to 5, it is annuity. What are we discussing about? We are discussing about our cost of capital, which we were given as 24%, and not 20 like our brother was able to read it, 24%, 5 years. Plus, we had our terminal cash flows at the end of the year, which is 400, times the present value interest factor annuity. 24%, it is annuity? No, it is not annuity. Because we are getting it once at the end of the termination, 24%, 5 years. Then we subtract your initial outlay. Our initial outlay is how much? We were getting, our initial outlay is 880. I think hapo tunaelewana. Hiyo tutapata hapo in Kenya shillings. Haya. Sasa mwanafunzi mmoja ataniambia the formula to use to get the present value interest factor annuity. Tulisema ni 1 minus 1 plus R raised power negative n divided by R. So how am I going to be getting that? And also about this one, we say this is 1 plus R raised power negative n because it is lump sum only once. Only once. So let's start with the first one. So here we just say it is 1 minus 1 plus 0.24 raised to power negative 5. Then we divide by 0.24. How much are we getting here? 1.24, you raised to power negative 5. 1 minus answer. Then we divide by 0.24. I'm getting 2.7, right? I'm getting 2.7, right? So it will be 378.8 times 274, 2.7454 plus, right? The other one will be 1 plus 0.24, you raise to a negative 5. So it will be 1.24 raised power negative 5, and we are getting 0.31. So it will be 400 times 0.3411. 0.3411. Then we subtract our initial outlay of 880. So you just need to put this on your calculator. It will be 378.8 times 2.7454 plus 400 times 0.3411 minus 880. We are getting 296 here. It will be 296. 296.40. 296.40. What about when we go to 1 to 10 years? 1 to 10 years. Very simple. 1 to 10 years. Calculate the NPV for 1 to 10 years, and I will be able to say the annual net cash flows is 376.4 times the present value interest factor annuity, 24%, 10 years. Minus, they don't have the terminal cash flows. So the same way you add 400. The 400 is only for 5 years. Hapa hakuna na hapa hakuna. So you just subtract the initial outlay of 880. 880. So how much is this? I say 376. 376.4, no. So we are going to be applying our formula again. So, but here, I just change for me, you just change for me to 10. So I just do it 10 there. So it will be 1.24, I raised for negative 10. Right? Then I take 1 minus answer. Then we divide by 0.24. I'm getting 376.4. You multiply by 3.68. 3.6818. So how much it is? So I say 3.6818. It should be 19. That is what you are going to be finding on your tables for annuity. So 3.619. You multiply by 376.4. What are we getting here? We are getting 1385. Right, 1385.8687. 385 for that. Is that correct? I see it is not. That one is not. 376. 376. Right, 376. Correct, it is correct. So we are getting 1385 minus our initial outlay of 880. Our initial outlay of 880. And I'm getting 505.87. 505.87. Let us do for the third one. The third one, 1 to 15 years. 1 to 15 years. And 1 to 15 years will be like what? 1 to 15 years. It is very simple. Look on your cash flow, 367,000.4. Multiply by the present value interest factor annuity, right? We are talking about 24%, 15 years now, minus our initial outlay of 880. So here we take 367.4, we multiply by what? Let me use here, right? The same one, and I say 15 now. So it will be 1.24. We raise for negative 15. 1 minus answer, right? Then we divide by 0.24. Minus, sorry, this one, we are getting 4.0013. Then you multiply by 367.4. I have said 4.0013 times 367.4. Getting 1470 minus 880. Minus 880. Getting 590. 590.08. 590.08. But the examiner is not asking for all of that. The examiner wants us to get the expected net present value, right? Expected the net present value. So how are we going to be getting it? We take our NPVs, because you can see we have our NPVs. We have for 1 to 5, we were able to get here 296. 1 to 10, 505. 1 to 15, 590, right? But how am I going to be getting the expected? You subject the probabilities. Examiner was able to give you certain probabilities there down. So he was able to say 1 to 5 years, amekupea probability. 10 years, amekupea probability. 15 years, amekupea. So in this case, just take your NPV. So we start with 296.4. We multiply by the probability. I can see the probability is 0.20. Plus, the other one is 505.87. You multiply by the probability given by the examiner 0.50 plus the third one, which will be 590.08 times the probability given, which should be 0.30. This one you put on your calculator and you get straight away. So it starts with 296.4 times 0.20 plus 505.87 times 0.50 plus 590.08 times 0.30. What am I getting? I'm getting a good answer of 489, sorry. This is what we are supposed to be getting, 489.24. 489.24. 489.24. And already we have 4 marks now. Already you have 4 marks. Then number 2 is asking to calculate the expected the standard deviation of the expected net present value, right? And this is very simple. This is very simple. How is it simple? Let me show you here. Let me show you here. To get the part 2, the examiner is asking us to get the standard deviation. We said to get our standard deviation, we take the root of the summation of our return minus expected return squared. You multiply by the probabilities. Now, in this case, we are using NPV. So what am I supposed to be using in this scenario? Because we are being told for the NPVs, I'm supposed to be taking the summation of NPV minus the expected NPV squared, then you multiply by the probabilities. That is how it goes. So let's start with the first one. So in this case, when you look on it, the NPV, it is 296.40. So you just take 296.40, right? Minus this one now. Because the expected NPV of yours is 489.24 squared. Then you multiply by the probability for the first year, which is 0.20. The second one will be, right? We have talked about 505.87, right? Minus 489.24 squared. We multiply by 0.50. Then the third one and the last one will be, right? We have talked about 590.08 minus 489.24 squared. We multiply by 0.30. So how much is this? Let me start with the first one. 296.40 minus 489.24, right? Squared. Then I multiply by 0.2, getting 74.37.45. Then the second one will be 505.87 minus 489.24 squared. Then we multiply by 0.50. This is going to be 138.28. Then the last one, 590.08 minus 489.24 squared. Then I multiply by 0.30. And we are getting 3050.61. What is the total here? What is our total here? Now, in this case, we are going to be getting plus 138.28 plus 74.37.45. We are getting 10,626.34. So in this case, I just say, to get my standard deviation, I just need to take the root of my summation, which is 10,626.34. So how much is this? I just say the root of my answer now, and I'm getting 103, right? 103.08. 103.08. Hiyo tumemalizana nayo. Hiyo tumemaliza. So the last one that the examiner is asking. Examiner nakwambia, when the company is basically exposing itself to financial distress is when now it reaches 200 and below. And you remember very well, there is a formula for the normal distribution because that is what he has told you to use. He has said, use your Z-score. You remember there before we used to say it is X minus U, you divide by standard deviation, right? But in this case, we are going to be using what, right? In this case, we are going to be using what? We are going to be using NPV minus expected NPV, then you divide by our standard deviation. Remember, hapa lazima utumia kaugali so that you can be able to get whatever the examiner wants. So nakuja hapa tunachora kaugali because it's a normal distribution table. So nachora kitu kangu kana namna hii. Kila kitu niko nayo. Na divide hapa namwambia my expected NPV, hapa kitambo we used to work a mean. Expected NPV of ours, we have said is 489.24, right? Examiner nasema kampuni ikiwa chini ya, so this is the point away from the mean, by the way, which is our NPV now, should be 200. Ametuambia ni so mbili. Ikishuka chini ya 200, the company will expose itself, again, the company will be able to expose itself to financial distress. So we are being told to determine the probability that the firm will avoid financial distress. Sinipande ya juu. Because ikishuka chini hapa, it will expose itself to financial distress. So if we don't want to expose itself from here, the NPV point and above. Now, the one thing that you need to understand about the normal curves is that the area under the curve is always equal to 1. So once you divide here, it means this side it is 0.5. Na ingine is 0.5. But we don't want all of this fully. We just need to know the region from here to here. So let me talk about the wanted side, by the way. This is our wanted side. Now already tunajua hapa ni 0.5. Na hapa ni ngapi? So we can be able to calculate it using the Z-score, right? So in this case we say, and you know your standard deviation now, you have gotten to be 103.08. 103.08. So you can be able to get it by taking the Z-score. So how am I going to be getting it? Very simple. I just say, take 200 minus 489.24. Then you divide by 103.08. 103.08. So it will be 200 minus 489.24. You divide by 103.08. We are getting 2.81. Another student will be asking me, Mwalimu, mbona you have avoided to use a negative here? And I will be able to tell you, the negative are normally ignored under the Z-score. We don't use negatives. So in order to get the probability, remember this is not a probability. To get the probability, go to the table, the normal distribution table. Normal distribution table. Nitakuonyesha how to read it, right? It just goes from the table. Let's tuangalie from our question kama tuko nayo. Right, examiner hakutuwekea hapa. Right, hakutuwekea. Can we be able to borrow it from somewhere? Yes, we can be able to borrow from another paper. Right, let me see whether another paper is having one. We can borrow it. Yes, there is another paper which is having it. Right, it is good. So let me share here so that you can understand how you can be able to check this from your paper, from your table, sorry. So the examiner has given us 2.8. I just go straight away to my Z-score. Even when you look at it to the normal distribution curve, the examiner has given you the Z-scores, right? Under a given column. Then we are going to be taking the 2 point something. So in this case, ours is 2.8. You can see it here, the 2.8. then it is 2.81. So I just need to go, I just want to go row-wise. So I just come and master the upward. So I know it is the second column. So it will be this one, 2.8, and then I go to all the row-wise. And I will be able to get 0.49, right? It will be 0.4975. 0.4975. So to get the probability that the examiner wants, let us go back now to our board. Let's go back to our board now. To get whatever the examiner wants, because we are being told the 0.4975, which we have gotten from our normal curve table, ni ya hapa 0.4975. Ni yako karibu. But wewe unataka kutoka hapa mpaka hapa. So how am I going to be getting that? I just need to say, let me take 0.49, right? 0.4975 plus 0.5. How much is this? And I'm going to be getting 0.9975. 0.9975. 0.9975. Any question? Any questions so far? Anybody with a question? Are we okay? Let me start with the Immaculate. Are we good?
Yes,
Immaculate,
yes,
are
I'm
you
good. No, I am good.
Good. What about Anne? Anne, are you okay?
Yeah, I'm okay.
Thank you. What about Godfrey?
I'm good.
What about Rose? I have not heard from Rose today. Ah, that is much good. So I just want to, I'm not giving you assignments right now. I just want to be, the assignment that I'm giving out, you repeat whatever we have done. Just repeat whatever we have done. Once you repeat whatever we have done, then I will be happy, right? Then tomorrow, I will just be able to start our class early, and unless something comes across. I just want to start our class earlier, since I just want to get in touch with the techniques of handling risk. But before we go there, I just want tomorrow to do investment decision under inflation. Investment decision under inflation. Investment decision under inflation. Then after that, we shall be able to engage to the techniques of handling risk. Tujue swali ya last semester ilitulemea wapi, swali ya previous semester ilikwamia wapi, among more questions that we are going to be, I'm going to be posing to you as we soldier on. Can we stop at that point? Can we?
Yes. Yes.
Thank you so much. Can I wish you good night?
Good
You
night.
too.
Good night. Good night. Good. See you tomorrow.
Okay, bye.
Bye-bye.